Hi, and thank you for joining us today for our webinar, Grocery Wars, Rise of the Machines. I'm Garrett Nelson, Vice President of Equity Research at CFRA, and I'm joined by my research colleagues, Arun Sundaram and Andrew Tam today. Before starting, we begin with the following disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. As I mentioned, the presenters on today's webinar will be myself, Garrett Nelson, Arun Sundaram, and Andrew Tam. Arun and I are based in the US and cover the consumer space, while Andrew is based in London and covers many of the European consumer names. On slide 4 is our agenda. First, we have a few intro slides about CFRA. Then I'll provide an overview and outlook for the sector and the sub-industries we're going to be talking about today. Next, I'm going to talk about grocery e-commerce trends before handing it off to Arun, who's going to discuss some of the challenges facing the industry. Then Andrew is going to cover how robotics and automation are driving profitability. Then we're all going to look at company implications for each of the companies we follow. And then we'll leave some time at the end for Q&A. And you can submit questions at any time using the chat function in GoToWebinar. Here's a timeline of our history in more than 90 years as an independent research firm. I'd like to highlight the two most recent events showed here on this slide. Slide 5, CFRA's acquisition of S&P's equity and fund research business in 2016, and then the acquisition of ETF data provider FirstBridge in 2019, which helped bring us to where we are today as one of the world's largest independent research firms. CFRA has a proprietary methodology that blends fundamental equity with forensic accounting research techniques. Our research covers all 11 sectors and 68 industries, and our fundamental equity research on that side, we publish qualitative research on over 1,500 companies globally and quantitative research on more than 25,000 companies. Importantly, research is all we do. CFRA does not manage money or make trades and does not have an asset management arm, which we believe is a key distinguishing factor from many of our competitors. Now, for our industry overview and outlook. We're going to be discussing food retail today, which falls under the consumer staples sector, so we thought it would be helpful to start off with a top-down snapshot of the sector and then the industry, as well as the sub-industries that fall under the food retail umbrella. Here on slide 9 shows our current sector recommendation on consumer staples. We're currently underweight on that sector. The stocks in consumer staples account for about 5.8% of the S&P 1500 composite on a market cap weighted basis, making it the 7th largest of the 11 sectors. It consists of 12 sub-industries with a total of 76 stocks in the S&P 1500, and consumer staples equities tend to be characterized by relative earning stability and are largely value and income oriented. Most of these companies pay dividends, and currently the average yield is about 1.8%. This is also a lower beta sector. The 5-year average beta in this sector is 0.79. Here's a slide showing the recent performance of the 12 sub-industries within the consumer staples sector. Last year, consumer staples names outperformed the broader market in the early months of the pandemic. But for the balance of the year, growth-oriented and higher beta names had all of the momentum. So the sector actually underperformed the S&P in 2020. But hypermarkets and supercenters performed extremely well, and food retail just barely underperformed the sector's 13% average gain. And if we fast forward to 2021, consumer staples stocks have performed very well, as you can see from the chart on the right. But hypermarkets and supercenters have not performed particularly well, and food retail equities are up about 11% on average. So we're seeing some mean reversion taking place and many of the sub-industries across consumer staples so far in 2021. Slide 11 shows a profit share map of the consumer staples sector. And as you can see, the food and staples retail industry is by far the largest in the sector in terms of revenue share, but it also has the lowest operating margins by far, as you can see from the y-axis titled EBIT margin on the left. And now here on slide 12 is a look at the profit share map of the 4 sub-industries within food and staples retail. And you can see that EBIT margins range from just over 2% for food retail to about 4% for the hypermarkets and supercenters, which is the sub-industry that accounts for most of the revenue generation, mainly because Walmart is in that category, and they're far and away the largest grocer in the United States. You also have Costco, a major player that falls under that category. The US food retail market is close to a $1.1 trillion market, and Walmart is by far the largest player with a 24% market share, which is triple the market share of the second largest grocer in the US, which is Kroger. But overall, the US market is highly fragmented and ripe for consolidation, we think, as grocers struggle with margin pressures from e-commerce and also various cost pressures, such as possible minimum wage increases and other pressures. Meanwhile, the UK market is about a quarter of the size of the US and is far less fragmented, with the top 4 retailers having about a 70% market share. And in the UK, Tesco is the largest participant in that market. Our current 12-month fundamental outlook for both US food retail and European food retail is negative, reflecting concerns over sales deceleration as food at home demand moderates and restaurant sales pick up increasingly as vaccines are distributed. In both markets, we're seeing increased competitive activity from hard discount retailers, e-commerce, and others. Also, in both markets, we have concerns about margin pressures from a variety of factors which I just mentioned, including federal minimum wage increases, tax hikes, higher transportation and warehousing expenses, and other considerations. Slide 15 shows the different categories of food retailers. And really, you could argue that there are probably 7 or 8 different groups. But to simplify that for purposes of this presentation, we've lumped them into these 5 categories. I'm not going to go through each one, but the key point I would make is that they all have different business models that work for them. The hypermarkets and supercenters and disruptors, or e-commerce focused retailers, are the 2 groups which have really been the biggest winners from the pandemic. And the conventional grocers, or the incumbents as we call them, are losing market share to a few different categories. The hard discounters such as Aldi and Lidl, the hypermarkets and supercenters, which have picked up a tremendous amount of market share over the past year, and also the disruptors with the surge in e-commerce business. This next slide shows the increase in US at-home consumption of food and beverages by month starting last March. And the chart on the right, you can see the divergence between at-home and away-from-home consumption, which is really quite dramatic in this data series from the US Census Bureau. Slide 17 displays survey data showing that employee expectations of working remotely are still very high, with 72% saying they expect to be able to work remotely in the US and 65% in the UK. And not surprisingly, those who work from home also eat at home and spend more time on food preparation on average. So these survey results suggest that at-home consumption will remain elevated for some time, if in fact more employers do allow their workers to telecommute. Now let's look at grocery e-commerce and how that plays into these trends. First, in the UK, grocery e-commerce is ahead of a lot of other markets in terms of market share, accounting for 12.2% of total grocery sales in January. That was up from only 5.2% a year earlier. And you can see how that percentage really took off about a year ago when COVID-19 was declared a pandemic, which really accelerated what we consider to be a long-term secular trend. Now, let's look at the US on slide 20. And you can see that grocery e-commerce sales market share jumped by 200% from 2019 to 2020, as indicated by the orange line. E-commerce comprised only 3.4% of total grocery sales in 2019, but that percentage jumped all the way to 10.2% in 2020. And you can see what was forecasted for US grocery e-commerce sales growth prior to the pandemic, as shown by the blue dotted line. And in the post-COVID forecasts, which shown by the orange line, which essentially accelerated e-commerce market share growth by about 4 years. And major food retailers benefited from exponential e-commerce growth in 2020 from COVID, particularly Albertsons, whose growth was especially strong off of a lower base than some of the other names showed here. And while e-commerce growth has moderated across the board, it remains at elevated levels. And e-commerce sales growth has been one of the primary drivers of the explosive same-store growth figures we've seen from this group over the last few quarters. But this e-commerce surge also presents its share of challenges, which Arun will cover in the next section. Arun?
Thanks, Garrett. So in the previous slides, we illustrated the rapid growth of grocery e-commerce and just how much trends accelerated because of the pandemic. So while this rapid growth surely presents opportunities to gain market share, like we said, the downside is that it will come at a cost. And this is because grocery e-commerce fulfillment today is not very profitable. In fact, many smaller grocers actually generate a loss for every online order they fill, but they're offering e-commerce anyway because that's what the consumer demands. So in these next few slides, I'll take you through some of the short-term and long-term challenges facing the industry, and then Andrew will take you through what the industry is doing to address some of these issues. So I think this chart here does a great job in depicting how unprofitable current online fulfillment models are. All the way on the left, far left, you can see that in-store transactions typically generate 2 to 4% operating margins. And then as you move right, you can see just how margin dilutive different forms of online grocery fulfillment are. So the costliest form of online grocery fulfillment is in-store picking, where employees walk alongside customers and pick products from the shelves. Not only is this really labor intensive, but it can also result in poor customer service since the aisles could be crowded with employees. In-store picking for grocery delivery can generate an operating margin of about minus 15%, so tremendously unprofitable here. But if a worker picks groceries from a quote unquote dark store, which is essentially a store that isn't open to the public, you can generate some efficiencies, but you're still generating about a nearly minus 11% margin. And then when you use third parties like Instacart, you can generate additional efficiencies, but you're still losing about 5%, as Instacart can charge grocers up to 10% per transaction, something that few, if really any, grocers can now afford, given that online grocery shopping is going mainstream. The blue box on the right are the same fulfillment models, but for click and collect orders as opposed to home delivery. Given no delivery expenses with click and collect orders, the margins are a bit better here, but still not very profitable. So based on this chart, the quickest way to profitability is to use automation and charge a delivery or pickup fee. We'll get into this much more a bit later, but the big takeaway here is that the online fulfillment models heavily used today are highly inefficient, but new models are gaining traction to help improve the overall economics. All right, so next slide. So since online grocery fulfillment is so unprofitable, particularly if a customer chooses home delivery over pickup, grocers are actually turning to gig economy drivers from food delivery companies like DoorDash, Uber Eats, and Deliveroo to complete some of these deliveries. Albertsons recently teamed up with DoorDash to outsource some of this function, while in the UK, Morrisons and Aldi have partnered up with Deliveroo for grocery delivery. We think more gig economy drivers will be utilized in the future, especially from smaller grocers who are trying to quickly scale their e-commerce platform. And then in California, Proposition 22 recently took effect, which labels these gig economy workers as contractors rather than employees. So this set a labor standard that, if spreads, could eliminate more salaried workers and lead to more third-party delivery. Okay, so what's the long-term impact of all this now that we understand just how margin dilutive online grocery fulfillment can be? Well, Bain & Company conducted an analysis that estimated US grocery revenue growth versus profit growth over the next 10 years or so, and concluded that grocers are at risk of losing 30 to 40 basis points of operating margin if strategic action isn't taken to improve the overall economics of online grocery fulfillment. This is because they estimate revenues will increase by roughly $300 billion over the next 10 years or so, while operating profits will only grow about $5 billion. So in other words, profits will grow over the next 10 years at a 1.6% operating margin, which is roughly half the current rate of about 3%. So since operating margins are already so low in the grocery industry, losing 30 to 40 basis points of operating margin could be detrimental to many, particularly to some of the smaller grocers who might not be able to offset this headwind with other strategic initiatives. Okay, on the next slide, on top of low margin e-commerce sales, we think grocers will face several other headwinds in 2021, which is the main reason we have a negative fundamental outlook for both the US and European food retail industry over the next 12 months. In this slide, you can see the different forces grocers will have to face this year, including things like higher raw material costs, higher freight expenses, more promotional activity, greater shrink, which is just another term for wastage, warehouse startup costs because it takes time for a new warehouse to run at full optimal capacity. There's also lingering COVID-19 expenses, such as hero or bonus pay, and then things like cleaning expenses. Additionally, fuel margins are expected to normalize this year after experiencing extremely high margins in 2020. And also pharmacy margins have been pressured for quite some time now due to lower reimbursement rates from third-party payers. And then lastly, if this was enough, there's a possibility of a minimum wage hike later this year, which we think will disproportionately impact conventional grocers like Kroger and Albertsons. Also, President Biden is supposedly considering raising the US corporate tax rate from 21% to 28%. Not only will this hurt earnings growth, but it also means less free cash flow will be available to invest in various strategic initiatives, including things like e-commerce. All right, as margins are being squeezed by the various factors I just mentioned, the competitive landscape is also heating up. You have Amazon not only expanding their grocery e-commerce business, but they are also investing in their brick and mortar presence by opening new stores called Amazon Go and Amazon Go Grocery. So these are separate banners from Whole Foods. Amazon Go is more of a convenience store that offers limited products, but it also has a strong, fresh and prepared food offering for people looking to grab a bite for breakfast, lunch, or dinner. There are about 24 of these Amazon Go grocery stores in the US. And then Amazon Go Grocery, on the other hand, is a full-size neighborhood store, so more of a conventional grocery store. There's only one Amazon Go grocery store open right now, which is in Seattle, but we expect more of these stores to open later this year. And then you have Walmart, who's been upping their competitive activity as well with the launch of its highly anticipated Walmart Plus subscription-based service. This service was launched last fall to compete against Amazon's Prime service. And Walmart Plus costs $98 annually versus Prime's $119 price tag. And you can get unlimited same-day grocery delivery on all orders over $35. Walmart Plus is still in the early stages right now, and right now Walmart wants to focus on delivering a high-quality experience for its members before looking to accelerate its membership growth. And you got to keep in mind that Walmart, they're no stranger to the membership model. They have the Sam's Club banner, which has been performing very well across the US and international markets like China and Mexico. So Walmart has the expertise with subscription-based models. And then you have Aldi, which has been making a very strong push in the US. In fact, Aldi is on track to become the third largest grocer by store count by 2022. In 2021 alone, Aldi plans to open 100 locations across the US. And then lastly, you have specialty grocers like Sprouts Farmers Market, who's expanding across the US by opening about 20 stores per year. You also have independent supermarkets who actually make up about a quarter of the industry in the US. So all in all, a very highly competitive environment, which seems to be only heating up. Okay, lastly, we wanted to talk about Amazon for a minute because when they purchased Whole Foods back in 2017, it sent a shockwave really throughout the industry because the largest online retailer essentially declared war on the grocery industry. And at that time, e-commerce really wasn't a big thing in the grocery industry. You had only about 3% or so of grocery sales that were ordered online, which is much lower than other categories like apparel, where over a third of apparel sales came from e-commerce. And then things like consumer electronics, where roughly half of all electronics sold in the US are ordered online. So grocery e-commerce penetration was low, but Amazon saw the opportunity opportunity to penetrate this category. But now it's been more than 3 years since Amazon purchased Whole Foods. And while Amazon has gained grocery market share, it's still far from dominating the grocery industry. You saw the graph that Garrett shared in an earlier slide. Walmart still controls about a quarter of the grocery market in the US, while Whole Foods' market share is only about 2%. So why has Amazon been slow to dominate the grocery space? Well, we think even the world-renowned online leader has an Achilles heel, and that's really because of 3 things. 1, its geographic footprint. 2, its inexperience in handling grocery products. And 3, because of its capital allocation strategy. So the first point about geographic footprint, Amazon's distribution network is really centralized and it's optimized to serve regions. This is great, when you're handling general merchandise items or non-perishable products, but when it comes to highly perishable grocery products, we think the incumbents have the edge here because most of them are located just a few miles from the end consumer. In fact, no retailer in the US has a stronger geographic footprint than Walmart, who states that about 90% of the US population lives within 10 miles of a Walmart. That's really just a mind-boggling stat if you put that into perspective. And then on the second point, existing grocers have significant expertise moving low-value products across different temperature zones. Grocery retailing may sound relatively straightforward, but in actuality, it's a highly complex business because grocers typically carry about 30,000 items with nearly 60,000 SKUs. Plus, they have to navigate through the complexity of different temperature zones. Okay, lastly, we think Amazon's capital allocation strategy could be a disadvantage to its own grocery business. And this is because we think Amazon's strategic priorities lie within its Amazon Web Services business, which generates much, much higher margins than grocery. AWS generates about 30% operating margins, and has grown operating income at a roughly 35% compounded annual growth rate over the past 2 years, while food retail generates between 2 to 4% operating margins. So 30% operating margins for AWS versus 2 to 4% for food retail. So what we think this essentially means is Amazon could increase grocery market share if it chooses to, but we think more of its capital will be allocated to its high growth, high margin AWS segment. All right, so now that I've taken you through the challenges the industry is facing, Andrew will walk you through some of the things that the grocery industry is doing to address these concerns, which includes some pretty cool stuff, including things like artificial intelligence and robotics. So Andrew, I'll leave it to you here.
Thanks, Arun. So we know that online grocery is largely unprofitable for the traditional supermarket chains, and it's margin dilutive. So that's a problem, and it's a problem that's only going to get bigger from here on as the online channel grows. So on this slide, there's mainly 3 main methods that the grocers have really utilized today that have helped them to add that increased online capacity amid the pandemic in 2020. So number 1, in-store picking. I mean, that's a form of online fulfillment that's really labor intensive, as we've mentioned. So it's inefficient, as existing store layouts are really more designed to make the in-store customer walk past a maximum number of aisles in order to, maximize their impulse buys, I suppose. So if you've ever wondered why the bread and milk are typically opposite ends of the store, I mean, that is why. So the other problem is then you've got the in-store pickers who are effectively competing with in-store customers for the same stock at the same time, which could make for a poor customer experience. So to try and alleviate that, number 2, some supermarkets have moved to dark store picking. That, once again, is also labor intensive. So whilst you don't have the issue of competing for stock with customers, the store layout's somewhat better optimized for online picking. It's still labor intensive, as I mentioned. So then thirdly, number 3, third-party picks from the store. I mean, that's where you get the likes of, say, an Instacart getting involved with a gig economy worker, picking the order off the shelf and ultimately delivering it. I mean, the issue with that is that, the pick and the delivery is effectively done by a separate company. So whilst it's been outsourced, some of the cost has gone away. It's still highly unprofitable, and it still comes with potentially a delivery fee for the customer. It's not a great customer outcome either. And then ultimately, in the longer term, I mean, the supermarket also risks the potential for disintermediation or loss of that ultimate direct customer relationship and of, I suppose, the margin as well, potentially. So then on the next slide, the question then becomes, well, how do grocers really, fulfill these online orders profitably? What can they do to make it more sustainable? and more efficient, I suppose. So we'll look at this over the next couple of slides. If you look at the online delivery supply chain, it's really the actual picking and last mile delivery costs that are probably the two largest components. And we think it's here that the grocery wars in automation are really going to be playing out. It's really hard to get hard numbers, but I'll try and give you a flavour. If you look at Ocado's UK online grocery joint venture with M&S here in the UK, as I said, at the EBITDA level, you'll see that about 40% of their cost base actually relates to fulfillment. Another 40% then relates to what they call trunking and last mile delivery. So I mean, that's 80% of total cost in totality. And then factor on, remember that traditional grocers, they're probably unlikely to see the same levels of efficiency, scale and profitability as Ocado retail, given that they've got so much automation in there. So indeed, those two components might even be higher within a traditional supermarket. And then the remaining 20%, that largely relates to things like marketing and other group level overheads and things like that. So probably not a lot you can do about that, but it's the 80% which is sort of right for the picking. Those two cost components alone make up about, in 2020, about 23% of sales. And it's this where, an optimized warehouse structure with automation, high levels of automation and robotics, could be really an opportunity here. And then ultimately, as I said, it's really about removing, that high cost of labour, the components of picking and handling, and really replacing with automation. I suppose the fundamental difference really is the use of what they call a goods to a packer technique, where the robotic machines, conveyor belts, manual handling equipment, they work together to bring all the stock and items to the order packer directly, rather than having the picker run around a dark store or a physical in-store supermarket fulfilling that order. So the idea really is to increase the pick efficiency, thereby lowering the fulfillment costs on a per order basis. And then secondly, short of really placing the store right next to the customer, the last mile delivery costs are relatively static. There's not much you can do, with eliminating the driver, but it's certainly one of the, future use cases for things like autonomous driving vehicles, but that's not something that's here yet. But for now, a lot of the automation focuses on the delivery routing, optimizing how the van itself is loaded and so forth. So on the next slide, delving into the two main methods here. So we've got, customer fulfillment centers, or CFCs. These are the two main fulfillment methods that seem to be evolving at the moment with automation. So with a CFC, you've got a highly centralized center that are championed by the likes of Ocado. They're really large footprint sites, so typically 300,000 square foot, filled with all sorts of digital capabilities, robots and automation to really move those goods around. High capacity, really centralized and used to service an entire region or a catchment area. And if you look at that table there on the bottom right, they can fulfill up to 200,000 orders per week. So something that would be pretty near on impossible to do out of a single in-store pick solution. And then secondly, the other alternative that seems to be developing is what they call an MFC, or a micro fulfillment center. That's also highly automated, but also significantly smaller in scale. So what some supermarket or grocery chains have been doing is they've been sort of locating or co-locating them next to an existing supermarket, and really used to, or alternatively used to, automate the dark store picking. As I said, it's a lot smaller in size, so only maybe 5 or 10,000 square foot, and process something like 4 or 500,000 orders. 4 or 5,000 orders, sorry, I misspoke there, orders per week. So it's a significantly smaller scale. But then again, it's still a pretty big efficiency gain off, say, a typical in-store pick solution, which might only be able to handle, a couple of hundred orders a week, or maybe up to 1,000 orders a week. So you still got quite a bit of efficiency gains over a highly labor-intensive model. Slide 33. So here on this slide, we delve a little bit deeper into some of the pros and cons of some of the fulfillment models. I won't go into every line here, but as you can see, we highlighted out some to draw out some of the key points in orange. I think obviously as you get larger in size, you have more and more opportunity to deploy more automation and robotics. But then again, also the upfront capital costs are probably higher as well. Then again, you know, in terms of the rewards, you've probably got more efficiency and scale benefit for that upfront cost as well. One of the problems is though, that the time to go live can be up to a year or more as these greenfield sites are really built out. But I think the key takeaway here is that, you know, there's a number of considerations, and there probably really isn't just a one size fits all approach. It really will be, we think, a horses for courses, so to speak, type approach that will be required. You might need to, for example, utilize a large scale CFC solution in a high density populated metropolis, say, you know, like a London, which is what Ocado has done here, or say New York City, or even an LA perhaps. And then in more sparsely populated areas, you might more opt for something like a lower volume MSC type solution, which is then close to the customer. So whilst at one end of the spectrum, you know, in a regional, other end of the spectrum, sorry, in a smaller regional country town where, you know, the order volumes are even lower, you might just look at a in-store pick solution, because even an MFC automation, it's still overkill versus the volumes, and the economics for the investment might not stack up at all. So on the next slide, we run through basically what some of the larger grocery chains in both the US and the UK are doing, and it's pretty clear that they're all investing in online. So if you ignore it, the likes of an Ocado retail in the UK, they'll come and eat your lunch. You offer it, and your customers will probably want a pretty efficient system with groceries delivered, you know, when they expect or when they want them to be, within a time slot, with minimal levels of spoilage, and a complete order with sort of low levels of substitutions. I think it's pretty clear that, you know, most of the grocers are implementing some sort of online fulfillment using a few key providers that seem to be emerging. You know, Ocado CFC solutions, certainly one of them. But then you've also got a couple of MSC smaller type solutions with the likes of, say, Takeoff or Dematic or Fabric. I mean, they aren't really household names, but you can bet in the next few years they will increasingly become more and more prominent. You know, then the other observational takeaway from this slide is if you look at someone like a Walmart, they're trialing a range of different solutions whilst also blending that in with an existing in-store pick solution to see what makes sense and offers the best economics. So it's certainly an area that's in flux at the moment. And then on the next slide, changing tack a little bit to the UK, or just to go zoom into Ocado a bit more. They've really been one of the first movers in adopting, I suppose, an online-only grocery model, you know, with high levels of automation. But they've really pivoted away from just selling groceries here in the UK. So since the launch of their end-to-end Ocado Smart platform, which happened in 2015, Ocado has really looked to sort of partner with grocery chains worldwide to help them implement automation and generate efficiencies in this new channel, I suppose. And really, for them, I suppose the strategic reason is pretty clear, because once they pivot to this partnership model, they open themselves up from what was, you know, just a 205 pound sterling UK grocery market to an addressable market that's probably more than 10 times that size at, you know, 2.8 trillion pounds across their key target markets. So, you know, they're opening themselves up to significant amounts of growth. Then slide 36, you know, having looked at some of the competing solutions, the one that does stand out is Ocado, just simply because of its size and scale. But I think that's quite a simplistic way of looking at it. the Ocado offering is a lot more than that. So whilst some of the competing offerings have really sort of evolved out of warehouse automation or manual handling equipment type specialists really to produce these MFC solutions, the Ocado Smart platform is really end-to-end. It does integrate sort of the automation hardware along with a significant, software solution as well. It is also modular, so it can be used to power, things like the online customer front end, whether that be the mobile app or the website, really all the way through to running things like, the fulfillment equipment inside the grid or the automated hive, as Ocado calls it, and powering also the last mile delivery process in terms of things like the smart delivery routing, how the truck or van is packed and so forth. That whole system's really been designed over a 20-year period. So they've got a significant head start over some of their competitors in terms of offering this grocery automation. And really, it's about offering, minimal levels of shrink and wastage, which are key costs for supermarkets today, and really scale to high volumes with, low levels of labor intensity. The system's really modular, as I said, and really the key attraction really is, one of the reasons why, grocers such as Pro in Spain, they've looked to utilize the system, just for an in-store pick solution rather than look initially, rather than go for the full-scale CFC solution. And that's a possibility. Meanwhile, on the other end of the spectrum, you've got someone like a Kroger and a number of other partners around the world. They've gone for the full in-store pick module on an interim basis, while their full-scale CFC solution in the sheds are really being built out. But overall, when you use the full solution, they've looked at some pretty attractive economics. So just to give you a bit of a flavour, an operating contribution, that's before centralised costs and overheads, as well as depreciation. So if you look at it just on a cash-on-cash basis, you get somewhere in the likes of a 10 to 12% contribution before depreciation, as I said, and an ROI of something of over 50% relative to the upfront capital costs. So pretty attractive reasons for why someone would opt for some of that level of automation. And then if you look at some of the Ocado retail stats, shrinkage and wastage, they're achieving rates of 40 basis points of sales relative to an industry standard of 2 to 3%. So there's significant margin improvement. So that's really before you implement some of the benefits of the automation, I suppose. And on top of that, Ocado's not done. They've got things like robotic picking techniques, which they're also looking to roll out. And that could offer, they think, an additional 170 points of cost benefits as well. So the economics stack up now, and they're going to get even better, we think. So on the next slide, slide 37, what does that mean? Ultimately, that pivot to that larger addressable market and partnering with these grocery chains worldwide, we think that they've got a really strong runway for growth. Really the ability to compound sales at almost 15% over the next decade. So really strong long-term top-line growth. That growth will also come through their existing UK grocery business, which is a 50-50 JV, but it's really their international CFC network, where they get to charge a percentage of sales as CFC fees, which will feed into that growth as well. But that strong growth in the top line will also mean that they'll have a reasonable path to profitability over the next few years as those CFCs come onto line and scale up. So on slide 38, and we've touched on this previously, but this disruption and reach for this increasing scale, as the automation comes at a pretty high capital cost. Several hundred millions of dollars. An Ocado CFC, up to 300 million in terms of full construction costs and things like that. So at today's rate, so if you want to play in this space and not get left behind, I think the takeaway is that you really need to scale up to justify some of those upfront costs. And really, it's for this reason that we think that some of the smaller mid-tier grocers they'll have to increasingly look to merge, particularly in the US, where the sector is really highly fragmented with that long tail. But it's equally applicable to other grocery markets that are fragmented as well. I mean, if you look at the slide on the right-hand side here, just as an example, Sprouts Farmers Markets and grocery outlets, they'll really struggle. I mean, they've only got 1/10 of the CapEx budgets on an annual basis, even versus the likes of, say, an Albertsons, even if you ignore what Walmart invests on an annual basis. So really, we think there's consolidation to come. So on the next slide, just to wrap up before we go into the company specifics, I think there's sort of a number of key takeaways from here. So number one, that really online grocery is here to stay. Customers are increasingly preferring it and demanding it, putting aside the pandemic. Number two, it's that the status quo really is unsustainable, and really that supermarkets worldwide need to take some sort of strategic action, really to stop the margin bleed, but also because they've got margin headwinds elsewhere, as we talked about in terms of the challenges. Number three, that really the key to stemming this margin bleed, specifically within the online channel, is really to reduce that labour intensity, and you really do that through increasing, throughput and efficiency through using things like robotics and automation. Number four, as one of the key providers of, the automation technology, Ocado really does stand to benefit, we think, from these secular trends. And then lastly, as I said, really the search for scale and that, demand on investment and CapEx budgets to fund that automation really means that where you've got highly fragmented markets, those smaller and mid-tier players, really will sort of reach towards realizing that they need to merge to sort of be able to invest and reach those synergies, I suppose. Now, we think that's true for the US, and as I said, that also applies to other markets as well. So with that, I'll leave it there.
Okay, so now we'll move on to STAR's recommendations, and we'll take you through some of the companies that we think are going to be winners and losers over the next 12 months. The first company, Amazon. So we have a 4 stars buy opinion right now on Amazon shares, because we think the company is very well positioned to benefit from the secular shifts in global e-commerce as well as their cloud computing. But when it comes to grocery e-commerce specifically, as we said before, we think the opportunities actually benefit the incumbents over Amazon. And this is because we think Amazon is disadvantaged with its geographic footprint compared to large food retailers like Walmart. Amazon also doesn't have much expertise as the incumbents do in moving these low value products across different temperature zones. Obviously Amazon's come a long way from just selling books online, but really food products are unlike any other category. And then lastly, Amazon's capital allocation strategy could mean that grocery is lower on its priority list compared to its high margin, high growth Amazon Web Services business. You can see on the chart in the bottom right just how important Amazon's AWS business is for its profitability. AWS is just 12% of Amazon's annual sales, but generates about 60% of Amazon's total profits. So we have a $3,800 price target on Amazon shares right now. And next, Garrett will talk about Walmart.
Thanks. Looking at Walmart, we currently have a hold opinion on the stock. There's no question they've been a big winner from the pandemic, and they continue to take market share from smaller grocers, boosted by their massive e-commerce and supply chain investments, which have now increased for 6 consecutive years and really helped enable the company launch Walmart Plus last September. We're cautious on the stock due to concerns regarding various cost pressures, as well as a view that its recent same-store sales growth rates are simply unsustainable, and earnings growth comps are going to become a lot more difficult. And I think that really showed up in their most recent quarter, the January quarter, in which their earnings were up only slightly, EPS was up less than 1% year over year. Despite a fairly strong holiday season, the Walmart US segment same-store sales growth was up almost 9% during the quarter, but they were hit by a variety of cost pressures, and so just barely posted year-over-year EPS growth, and in fact, their earnings fell 12 cents short of consensus, so it was a big miss. But we think there's no question they're favorably positioned in food retail, given their size and scale and their investment in e-commerce, supply chain, and automation. The other point I would make is that Walmart Plus really plays to the company's strengths, which are grocery and geography. Amazingly, over 90% of the population lives within 10 miles of a Walmart store. But the real challenge for them going forward will be holding the line on margins. And in fact, their operating margins have been steadily decreasing over the last several years. We're currently just about 4%. So they continue to face pressures. And really, Walmart Plus is not helping margins in the near term. And moving on to the next slide.
Okay, so we currently have a 2-star sell opinion on Kroger shares over the next 12 months. Andrew shared some of the very interesting things that Kroger is doing in the e-commerce space with its Ocado partnership. However, over the next 12 months, we're not only concerned of increased competition in the space, but also the various margin headwinds and cost pressures that we previously shared. So similar headwinds that Walmart's facing, like Garrett said. We think there's some margin headwinds include things like lower margin e-commerce sales, greater promotional activity as overall food at home demand moderates, which that will also likely lead to more shrinkage. And then you have warehousing and freight expenses increasing this year, as the overall economy heats up and looks past COVID-19. And then there's a possibility of a corporate tax hike and a minimum wage increase. And like we said earlier, the minimum wage increase we think will disproportionately impact conventional grocers like Kroger. So our 12-month price target on Kroger shares right now is $31. The last company we wanted to call out is Albertsons, which we have a 4 stars buy opinion on. So despite our view that Albertsons will face similar headwinds as a Kroger, we're more constructive on Albertsons shares because of its valuation. So right now, Albertsons trades at a discount to Kroger. And so Albertsons is more of a value play because we think its multiples could expand as it closes this performance gap to Kroger. In fact, we think this year, which is going to be fiscal year 21, Albertsons EBITDA margins will surpass Kroger's. You can see the chart on the right in our estimate of Albertsons gross and EBITDA margins. There are also a few other characteristics of Albertsons that we like, including its strong exposure to fresh items. About 41% of Albertsons sales are in the fresh foods category, while Kroger only has about a quarter of its sales exposed to fresh. And studies have really shown the quality of fresh items is the #1 determinant of where people shop for groceries. So since Albertsons already has a significant exposure to fresh and is now investing in this area to improve quality, we think Albertsons could gain some market share here. So our 12-month price target on Albertsons shares is $22. Okay, with that, that's our last company implication. So we'll be happy to take questions now. If you haven't already, please submit questions using the questions feature in the GoToWebinar.
Okay, thanks everyone. One minute while I compile the list of questions. The first one, it looks like, is for Arun. Arun, between Kroger and Albertsons, which company do you think has a stronger e-commerce strategy?
Yeah, it's a good question. That's something that we've been obviously analyzing and looking into a lot over the past year or so. Kroger and Albertsons, they've taken different routes when it comes to online grocery fulfillment. Kroger has obviously partnered with Ocado to build these massive centralized fulfillment centers. Kroger plans to introduce some smaller sheds in the future, but right now the warehouses being built are these 300,000 square feet sheds with Ocado. But Albertsons, on the other hand, has taken the micro fulfillment approach. So its online grocery fulfillment will be mainly from these mini warehouses that are attached to its existing stores. So it's quite different than what Kroger is doing. But I think it's difficult to say which strategy is better because we think each strategy works for each respective company. Kroger, they do have many stores in rural areas, so maybe it makes sense to build a big centralized warehouse to serve a bunch of these rural stores. And then Albertsons most of its stores are in urban and suburban areas, and a lot of these stores are, very close proximity with each other. So maybe it makes sense to build a mini warehouse, attached to one of its existing stores that can serve, a bunch of these stores in the small region. MFCs oftentimes do make sense in urban areas where real estate is really expensive, because with an MFC, you can attach it to an existing store, and you don't even have to expand your store either. You can actually just remove unproductive space within your grocery store to make space for this MFC. So the short answer is I think is each strategy works for each company. So it's hard to say one strategy is stronger than the other.
Okay, great. It looks like the next one is for me. The question is, a few weeks ago, Walmart CEO Doug McMillon presented his new strategy. Interestingly, Walmart plans to move into many areas that are not typically retail. What is this strategy all about? What I would say about this is Walmart has a long history of tinkering with various non-core initiatives, especially in e-commerce, where they've been very active with acquisitions, just smaller bolt-on acquisitions, and also making a number of divestitures of these businesses over the years. And I view these new forays into fintech and healthcare as along those same lines. And I think there are a few reasons they're exploring opportunities in those areas. First, they realize they need to diversify into higher margin, higher growth businesses, because their core brick and mortar retail business will continue to face long-term margin pressures from Amazon and e-commerce in general. And then secondly, competitors such as Amazon are making similar moves, and there's kind of a fear of missing out mentality. And then third, Doug McMillon has shown to be a lot more willing to experiment with these sorts of outside the box ideas than any prior Walmart CEO. And if you look at some of the acquisitions they've made, they've gotten into streaming. They bought Voodoo back in 2010. They recently divested that. They sold it to Fandango, I believe, last year. And then there's a number of e-commerce businesses, Jet.com, ModCloth, both of which they've divested, and then some other smaller ones that they've hung on to. So, I kind of view those moves into fintech and healthcare as kind of, exploring other potential business lines that might be higher growth and higher margin. Okay, another one for Arun here. You talked a lot about automation and robotics, but when will these investments begin to pay off? Because you mentioned lower margin e-commerce sales will be a headwind in 2021, so will it be sometime in 2022?
Yeah, it's a good question. So like we've said, MFCs and CFCs, both these fulfillment models are expected to grow really exponentially, and that's because online grocery is going to continue to grow, and many grocers need to move away from the highly inefficient in-store model that they have right now. But we think it'll take some time for profitability to really kick in, because many grocers are still in we call it the pilot stage of testing these technologies and fulfillment centers and so forth. So, and even once these fulfillment centers open, it's going to take some time to run them at optimal capacity. And to really generate the most efficiencies, you need to run these centers near full capacity. So I think it's hard to put a timetable right now, just because each grocer is kind of in a different stage of implementing automation and robotics. And I think it could, safe to say, it could take maybe 2 to 3 years for profitability to really kick in.
Okay, we have one here for Andrew. Could you discuss in a bit more detail on how the economics for Ocado's global partnerships work?
Oh, yeah, sure. Yeah, that's a pretty broad question, but I suppose if you think about the technology, I mean, the technology really has already been designed, in terms of the R&D costs. So they're effectively sunk. It was used to prove out the UK warehouses. So then by pivoting towards the global partnership, they're just taking something that's already been developed in terms of the product, and then just using that and applying it to an addressable market that's 10 times their existing market, I suppose. If you were to look at sort of, I suppose, Ocado's partners, as I think I mentioned on the slide, there was something like, starting at the high level, 2.8 trillion pounds sterling. That's about 4 trillion US dollars. If you were to assume that these partners sort of average or can get up to sort of 25% market share, you're talking significant, 700 billion pounds in annual sales. If you were to apply some pretty conservative penetration rates to that, and apply kind of CFC fees, so they charge roughly about 3.5%. That's talking to something like 3.5 billion in annual fees, just for Ocado. When you compare that to what they make at the moment, 2.3 billion sterling in 2020, that's pretty good growth opportunity out there as well. So I think there's a pretty good chance that as these sheds roll out, you can get sales really more than doubling from here. And Ocado themselves, they've talked to a 3.5 billion to 26 billion opportunity, depending on what assumptions you use around penetration rates and things like that. So it's highly attractive, and yes, you'll have to factor in things like the capital expenditure up front to build out the kit and DNA costs and things like that. But really, I think a lot of the heavy lifting has really been done in terms of R&D. Look, they're still reinvesting in things like robotic picking and things like that. But look, I think the economics are pretty good looking forward. And then lastly, I think the growth is pretty strong out there. I mean, if you for a grocery analyst, when you used to looking at 2 to 3% growth, to see something growing at double digits is pretty attractive. Probably the last thing I would say in terms of economics.
Okay, great. I think we only have time for one more question, because I have a couple things I want to highlight after this last question. But this last one is for Arun. Could you talk more about the competitive dynamics, how the competitive dynamics have shifted in the grocery industry since the pandemic began? Who do you think will be the winners and losers as we exit the pandemic?
Yeah, so good question. So I would say the competitive dynamics have shifted to the benefit of the larger grocers from the pandemic. So before the pandemic, smaller specialty grocers were gaining a good amount of market share, but then the pandemic hit, and consumers wanted to really consolidate shopping trips to avoid contracting the virus. So most of them, or many of them, went to larger grocery stores that were essentially a one-stop shop, instead of maybe going to a smaller specialty grocer just for a few items and then going to a big box retailer for other items. But as we look past the pandemic, it's really unclear whether this trend will stick or not. But even if it reverts back to the quote-unquote normal, it could take time, because just these in our behavior. We've all been living in this pandemic for a year now, and certain habits are just so deeply rooted. So it could take some time to change. And I guess the only other point I would quickly make is that larger grocers, as well as the hypermarkets and supercenters, they were the ones that really invested in e-commerce early on. It's really the smaller players that are now scrambling to scale their e-commerce business and really add capacity. So I think that's another reason why the competitive dynamics have shifted to the benefit of the larger companies.
Okay, great. Just two final things I wanted to mention. If we skip ahead to slide 47, our next webinar is scheduled for 2 weeks from today. That will be on April 8th, and that will cover key ETF themes for the new normal economy. Will be hosted by Todd Rosenbluth, CFRA's Director of ETFs and Mutual Funds, who will be joined by Jay Jacobs, Head of Research and Strategy at Global X. And you can register via the link shown here. And then finally, you can find much more information about the industries we discussed today in our industry surveys, which are among the 68 industry surveys we regularly published, as shown on slide 48 here. So that's all we have. Really appreciate you being with us today, and hope everyone has a good rest of the week. Thanks very much.